some big earnings coming, and what your best strategy might be right now. Let's ask BlackRock's Rick Rieder. He's with me live today from the iConnections conference down in Miami. It's good to see you. Welcome back.
Good to see you. Thanks for having me on, Scott.
Hey, let me just ask you real quickly, just playing off of what Joe Kernan was just talking about with Kelly, the prospects that the president tonight, I'm not sure if you heard this reporting from Joe, who had a chance to speak with the president. President Trump's going to talk about more tax cuts tonight, both on the corporate side and the personal side, maybe leaning a little more in on the personal side. But with so much angst and conversation about the deficit, I'm curious as to what you make of that strategy right now from a White House that obviously is concerned about the affordability issue in this country.
So I'd say a couple things. First of all, I mean, I'm not terribly surprised that you would see more initiatives to keep growth moving. And I actually believe you got to keep growth moving in this economy. And if you're creating incentives in terms of tax incentives, listen, I think there's something that's got to happen. I know we've talked about it. I think the Fed needs to cut the rate. I think we got to run what is a hotter economy, and we've got to keep the rate at a moderate level, because the only way you diffuse the debt. There's a lot. When I travel around the world, I get asked all the time about the dollar and question about the dollar. And from my perspective, the way you stabilize the dollar in a durable way and the way you create that level of intermediate term confidence is we got to reduce the debt. And to grow the economy and incentives to grow the economy, I wouldn't be surprised to see more things, deregulation, business incentives. So it seems consistent.
I mean, it wasn't all that long ago, Rick, that we were talking about one of the reasons to be bullish this market was a run-it-hot economy. For all of the angst over AI spending and everything else, it was higher than expected growth. It was deregulation. It was better than expected earnings. I mean, do you think we're making too much about all of this AI angst, which certainly has the market a bit on edge?
God, it's a tough question. I mean, I will say this is one of the most fascinating, by the way, challenging markets. And I would say one of the tools that I found to be effective today is humility. In that, like, our funds are doing well, but it's like every day you get a reevaluation of some industries. There are some, like when the reevaluation of content. How do you create content? Listen, I think this is, when you talk about big market caps that can shrink significantly, boy, that changes the model around how you think about different equities. I still think at the end of the day, when you step back and say, gosh, you got an economy growing, I think it'll grow well above 5% nominal this year. You've got earnings growth that generically should be good on the backside of that. You probably got a market that will probably have a pretty good year. It's not going to be straight line. And quite frankly, the names underneath it, oftentimes I think the markets are wrong. Oftentimes I'm wrong. But I think you got to work through it and think about, gosh, at the end, are you moving in the right path? And like I say, we seem to be getting more right than wrong, but boy, you get frustrated with some of these moves.
Well, I mean, some are wondering whether, things have changed in the market. I want to read you something that Goldman's Tony Pasquarello said about that fact. And he's talking about some of the angst in the market over hyperscaler spending and how those stocks have been treated lately, where he says, quote, "The market narrative has changed. The simplicity of hyperscalers funding immense capex so easily has changed. It will now be a show-me story, with the onus on companies to attach revenue growth to spend." What's your reaction to that comment?
So I think it's right. I mean, I think how you think about different hyperscalers, and without going through individual names, we've adjusted some of our positioning around that because, quite frankly, I think you need to see the IRR and you need to see the durability of some of the businesses underneath it. By the way, there's also a technical condition that's quite significant. The amount of buyback we saw from hyperscalers over the last couple of years was immense, that you knew you had a backbone of buying into those names, that anytime you had any real pressure, you knew the buybacks would come in. So I think there's a whole series of things that I still like. If you said on an aggregate basis, I still like the hyperscalers quite a bit. I still think it's incredible how much top-line revenue they throw off, how much it drops down in terms of free cash flow. Clearly, a bunch of that would have gotten into free cash flow now is getting into CapEx. But I think people, when you step back and think about what is CapEx, CapEx is your future ROI or your future ROE in terms of your business model. So I think there's a near-term dynamic around it. By the way, in the credit markets, part of why we've reduced, and I'm sure others have, a fair amount of investment grade exposure that we have, investment grade credit. We're going to get a lot of supply into that market, and the spread levels just aren't that interesting relative to it.